We're fortunate enough this morning to have a few of our up-and-coming and senior partners to give us their views around the relevant issues coming out of the budget last week, having digested, reviewed and considered all of those aspects. So we'll give you the higher level issues and then talk about some issues at the back end of it around what that actually means for the economy and the key issues which may or may not have been dealt with as part of the budget. So on that basis, we'll move into it because we've got a lot to get through. I'd like to bring forward Joel, Senior Partner in Tax Consulting, to give us a view around the corporate aspects and those higher end sort of issues.
Yeah, thanks very much for that intro, Todd. So before I get started to the area that I would be focusing on today, which is the large business and international sector, there's just a brief snapshot of the various different issues that arise out of the budget, which might be relevant for this group here. And I won't touch on each one of those. It's just a bit of a snapshot about where we're going to take you. The first thing that I want to talk about today in terms of large businesses and multinationals is the announcement within the budget, which is probably the major one for that particular segment, is the proposed implementation of both a domestic minimum tax and a global minimum tax. Now that is slated to commence from the 1st of January 2024 in relation to what's referred to in the OECD guidance as the income inclusion rule, and for the untaxed profits rule for income years beginning on or after 1st of January 2025. So what do those two rules do? Well, the domestic minimum tax looks at the level of effective tax which is applied across domestic activities and can apply additional taxes if there's an effective tax rate which is less than 15% on a domestic basis. The target market segment for all of these taxes is a threshold level of 750 million euros, which is slightly higher than the existing threshold at which we apply the country-by-country reporting and significant global entity provisions. So there'll be an additional threshold to consider there. It's important to note that that doesn't just include your tested entity, it's looking at the entire economic group that a taxpayer operates in. And what it will do in some cases is, especially for outbound Australian-based businesses, when we look at the global minimum tax, it will, in some cases, include amounts of additional income such that global taxes become a 15% rate. In application, reading through the way in which the OECD has set out the policy background to the implementation of the global and domestic minimum taxes, we can see that it applies a little bit like our existing controlled foreign companies legislation. That is, it'll act to attribute additional income amounts to achieve a 15% minimum rate across a corporate group. So where are we at the moment? So Australia has signed up to the OECD proposals to implement those two aspects of Pillar 2 BEPS. To start from the 1st of January, not a lot of time for taxpayers who are in this market segment to become aware of and digest what will very likely be highly complex legislation, in that it has a whole new sort of definition regime to apply from that time. And the other takeaway that I suppose I see for this is for Australian-based finance teams. It's really key and important to understand what levels of effective tax are being applied across your corporate group, whereabouts all of those parties are, and then while most taxpayers will probably not be in a position where the global minimum taxes will have a practical application of having to pay tax in an Australian jurisdiction, it's very important to be able to diagnose, what levels of effective tax are occurring across a corporate group. So in a lot of cases, that will need a whole new level of communication and reporting across multinationals than has already been the case currently to manage Australian-based risk.
And Joel, you're working with our international teams to be able to try and bring some of that together to assist, because obviously it is an issue where the tax professionals in each area, each country are going to have to work together to be able to try and make it as smooth as possible. Otherwise, it'll just descend into chaos.
Yeah, and look, there is already a slight sense of chaos in the sense that we have rules which apply from the 1st of January, and we have the policy outline, both from Treasury and from the OECD, but what we don't have is legislation to implement it. So that will be the challenge, is understanding how that transition happens. Also that each country will have a different timeline for the implementation of these measures. Okay, might move along to the next one. So the next measure, this is one of those things. Often you'll read something from the policy documents and the Treasury papers and think, what exactly do they have in mind? And I think it's fair to say this is probably one of those ones, because there's not been an enormous amount of explanatory material which has accompanied this particular measure. It's a fairly pithy announcement. So there's an expansion to the anti-avoidance provisions, which we like to refer to sometimes as Part 4A, and there's two particular areas that have been identified where they want to expand the policy basis of the operation of the anti-avoidance rules. The first one is that the anti-avoidance rules will have application where, for example, the dominant purpose of a transaction or a scheme, as it gets referred to, is perhaps to reduce foreign taxes, but it has a non-dominant purpose of giving some kind of Australian tax benefit. So until now, that was probably excluded because it would not be a dominant purpose of deferring or reducing Australian tax. That will now be subject to potential application under the general anti-avoidance provisions under the changed rules. The second aspect was, and this is a little, again, complex to understand the policy thinking here, is to identify situations in which lower tax outcomes as a whole have been achieved through getting into lower withholding tax rates in relation to payments to non-residents. So the legislation, when enacted, would look to eliminate the tax benefit from getting into that particular position. A couple of other aspects to talk about this morning for the build to rent concessions. So there has been a fair bit of state government support to date, and a lot of these measures and the eligibility to get into them match up with the eligibility for concessional treatment for the various different states. And the two headline aspects to the build to rent increased concessionality are that the capital works depreciation will go from the 2.5% rate to 4% rate. And where build to rent is conducted through a managed investment trust, that the withholding tax that applies from that type of income will in fact go from 30% to 15%. One which I think is interesting in terms of determining the direction of travel from the tax office's administration of law. We have an amnesty which essentially deals with what you might call the high impact aspects of COVID-19. So what does it do? It will allow a remission of all failure to lodge penalties which arise between, or would have arisen between, July and December this year. So it hasn't started yet. And now it doesn't apply to all late lodgement obligations. It only applies to those which would have been would have arisen originally between December 2019 and the 29th of February 2022. So that 2-year and 2-month period. It's not all taxpayers. It applies in particular to businesses with a turnover which is less than $10 million. So if your turnover is greater than that, or you're not in business, then these particular amnesties don't apply. Now, why is that of interest of itself? Well, first of all, it gives you a good incentive to go and make sure that all of those outstanding lodgement obligations are met and satisfied by December this year. For a lot of taxpayers, maintaining compliance, especially for small business, has been a bit more challenging than at other times. But also, I think it's fair to say we can see, and Donna will touch on some of these points later on, the tax offices being allocated increasing amounts of resource to pursue lodgement and collection of, in particular, business taxes. And so it's reasonable to expect after the amnesty is done, the tax office will have a less concessional approach to outstanding lodgements. So probably better to get that done in the next 8 months rather than to leave any outstanding lodgement obligations beyond that.
And we're seeing that a bit with distressed businesses, Joel, where they're focused on just paying wages and keeping things going, and some of these things slip where they just don't have capacity or it gets too complex, so it gets sitting on the wall. And when you do rectify it, often it's actually not as bad as what people think, but it's just one of those issues.
We've certainly seen that the tax office is decreasingly lenient on extending periods available to meet your lodgement obligations compared to, say, a year or 2 years ago. And so what we're finding is there's It's quite a lot of catching up for a lot of taxpayers to do in terms of getting their lodgements up to date.
Okay, thanks, Joel. Over to Peter to bring us up to date with the critical issues in that private and family business, and for individuals where he deals with the daily cut and thrust of all of the issues that those type of businesses have. So Peter, take us away.
Thanks, Todd, and good morning, everyone. There probably wasn't too much in there for individuals, at least from a tax perspective, and we might touch on later that we got those decreasing tax rates coming from 2025, and they're still happening. But a couple of things for businesses: the instant asset write-off. We have up to the end of this financial year had something called temporary full expensing. And I think a lot of us in the tax world have probably forgotten how to depreciate, because we've been able to write off assets, that are with no threshold for businesses with turnover up to 5 billion. So that's coming to an end at the end of 2023, along with, if that led to a tax deduction, or if really anything, led to a tax loss, we're able to go back and claim that loss against previous income for corporate. So that's gone and come to an end at 2023. What that means is it reverts to the usual legislation, which we have something called instant asset write-off for small businesses. I use the term small business, but the legislation has so many different definitions of small business. For this one, it's 10 million turnover. Now, it usually would be $1,000, but the budget's increased it to 20,000 until June 2024. So we can get an upfront deduction for what otherwise would be capitalised if it's installed and ready for use by June 2024. I guess a point on that temporary full expensing coming to an end at this year. If you do have capital expenditure coming up, you might want to look to get that in before this one ticks over. So this was one for energy incentives, sort of an interesting one, but there's an extra 20% kicker there for small businesses. In this case, 50 mil turnover, get an extra 20% deduction. There's not too much detail in terms of how that would work. Usually this would be depreciated assets, so do you get that 20% upfront or across the life? I don't think we have that detail. A little bit of administration, I guess, identifying that spend, but that one's going to apply for any spend from July 23 up to June 24. The couple tweaks to superannuation. So this one we've got until 1 July 2026 to get ready for, and it's quite a substantial change from how things are happening at the moment. So at the moment, superannuation is required to be paid, I think it's 28 days the month after quarter end. Now, what's been announced is that will now have to be paid at the same time that the employees are paid. So you can see that's a big change to cash flow, big change to how things are administered. And also, if super's not paid on time, it's not tax deductible. So you really need to be on top of this and have appropriate systems in place. Again, we've got a long lead time here, a few years, for probably those payroll systems to get themselves together. This little bit of a controversial one in the sense that it's kicked up a fair bit of discussion. Just generally as a point, I'm seeing 30% across the board on a number of different measures as being a rate that the government seems to be happy with tax on passive income. If you talk about family trusts, let's say if you're using a bucket company, which has a tax rate of 30%, move the cash into that bucket company. We're talking about the tax rates later on going to 30% for up to 200 grand income. A couple of other instances, there was a policy which Labor brought to the last election about 30% on family trust income. So just as a broad statement, that seems to be a minimum tax that the government's expecting on passive income. So this one particularly is for super funds where they've got total superannuation balance of $3 million. I think the government said that that's going to affect about 80,000 taxpayers, but I've heard that perhaps it could be quite substantially more. But what the discussion is about is more how it's being calculated. And they're using a definition of earnings, which is an increase in that total superannuation balance. Now, if you take that definition, that includes unrealized gains. And now that's something that we don't have anywhere or very few places of our tax system. So it's simple from the government's point of view for administration. Apparently, we'll see, we don't have too much detail, but quite an unusual tax outcome there.
So Peter, in summary, it sounds like the ATO is trying to get the superannuation paid instantaneously, and they're going to try and collect more cash out of the superannuation system to be able to improve their position going forward.
Yeah, that's broadly right. I mean, these funds, 3 million super balance, might be the minority, but previously they enjoyed, if they were in pension phase, enjoyed completely tax-free earnings. Then there was this 1.6 mil cap brought in, that anything above 1.6 is taxed at 15%. And now going after the higher end of over 3 mil at 30%.
But to get to 3 mil, it means you've made significant investments in there, or you've been extremely lucky with some of the investments in there.
You've made a unicorn.
Yeah. So on that basis, there may well be significant fluctuations in the balance. So you could have unrealised gains and then unrealised losses. And how is that all going to work?
Yeah, absolutely. And we'll wait to see the detail. I mean, there's talk of it carrying forward and losses being recouped and various things, but I do agree you've got a valuation on I don't know, something like Canva in there, and it's worth 30 mil one day, worth less the next.
Let's not talk about crypto. All right, on that basis, on collections, we'll move along to our prime contact with the ATO at the moment, and I can tell you from personal experience that Donna has really been helpful in communicating with the ATO for me and helping manage a lot of the things, particularly with some complex lodgements and historical debts. So I'd recommend, if you have any issues with the ATO and to how you want to engage with them, is to reach out to Donna. So she'll give us an update on where the ATO is at and how they're engaging with everybody. Obviously, they got some good news in the budget as well, Donna.
Yeah, thanks, Todd. What an introduction. Good morning, everyone. Done some recent work for Todd. And I do have a bit of a soft spot for the ATO because I was previously a client engagement director there. I came across the HLB in August last year. And since then, I've been working in the corporate tax team alongside Joel on large corporates and multinationals, including some of our SGE clients. So I guess, with the recent budget, the ATO has been a bit of a winner. As you can see, based on what Joel and Pete have been talking about, the key theme of the budget that the government is seeking to respond to inflation. And I guess in terms of, in absence of any real tax reform to address that kind of structural funding issue with the budget, that the revenue side of the budget really does heavily rely on the enhanced compliance activities by the ATO. So they have received additional measures aimed at making the tax system work harder to extract more revenue from the economy, not only to reduce the budget deficit, but also, I guess, in some sense, to counter inflation if they can. And the ATO will focus mostly on those that they consider are non-compliant. It's not a small feat that the ATO have been tasked with. The returns Treasury are expecting from the ATO are substantial. So, for example, from just a couple of measures, the GST and the individual tax compliance measures, and the ATO are expected to generate about 9.1 billion in revenue, which isn't a bad return for about 670,000 in investment from the government. So I guess moving on to the measures, the ATO has been funded 588 million for their GST compliance program, which I will speak a bit more about on the next slide. They've also been given 89.6 million towards the personal income tax to extend that compliance program for 2 years from 1st of July 2025, and also will have a bit more of an expanded scope from 1 July. As Joel spoke about earlier, there is an ATO small business amnesty for small businesses which have fallen behind on payments. What that amnesty does is remove the failure to lodge penalties, and it will focus predominantly on businesses who have disengaged with the tax system altogether, so long as their turnover is less than the 10 million. And it does cover those lodgements from, covering the COVID period between December 19 and February 2022. And while it may seem that the ATO are continuing to support small businesses with this particular measure, I'm not sure if this is actually the case, because they've also been funded to chase taxpayers with high value debts. So those with debts over $100,000 and aged debts older than 2 years, where those taxpayers are either public and multinational groups with an aggregated turnover of greater than $10 million, or privately owned groups or individuals controlling more than $5 million of net wealth.
And Donna, we're definitely seeing them being more forceful in recovery of their debts, and they're back anybody who does not come up with a reasonable payment plan. They just put them through the process. And obviously there's all of these measures here, but it doesn't get the directors out of their personal liabilities and all of those things. It's more for at a company level.
Yeah, correct. And I will talk a little bit about the directors on the next slide. But I do think that there is definitely a change in the behaviour that the ATO now have towards small business debt. So as I mentioned earlier, the GST compliance funding is quite substantial, and I think it does show how huge a focus that this is for the ATO, with almost 6 times as much funding as the personal income tax program. I do think a lot of this has come on the back of the risks that they identified last year with Operation Protego. Some of you may have read about it, where the ATO were tackling quite a lot of GST fraud. You may have seen advertised on social media and the like. So $588 million is to help the ATO develop more sophisticated analytical tools to help combat those emerging risks to the GST system, and to continue with a range of compliance activities to help promote GST compliance. And those activities will focus on taxpayers accurately accounting for and remitting GST and correctly claiming GST refunds. And GST is an important area because it can be a bit more of a systemic issue where, you know, any errors in your reporting, they have the potential to be compounded month on month as you're lodging, continuing to make those errors. So it's really important that your processes and procedures around GST, you know, are quite robust, and that if you do need any assistance with that, please reach out to us. You know, it can have a huge impact on your obligations with the ATO, and I think that's also a reason why the ATO have been focused here, because it will have the implication that it can have a huge impact to their wider revenue effect. We have seen an increase in the activity in GST, and I guess HMRC over the last few years noticed that, and that kind of led us to make the decision to bring in a dedicated GST specialist to bolster our GST offering. So we really are, you know, well equipped to aid you in this area. And then, as Todd was mentioning earlier, you know, it does have impacts on directors personally, because as of 1 April 2020, GST is now subject to the director penalty notices. So, you know, the ATO will seek to recover these debts, and maybe as early as or as soon as the small business amnesty is over. So please take note. And then just a comment on the ATO debt collection. I think I previously mentioned that, you know, there's about 30 billion in current debts owed by small business alone. In a recent article, Deputy Commissioner Will Day of the small business line confirmed that the ATO collection efforts are now on a firmer footing than in recent years. And the number of enforcement activities from the ATO are expected to hit pre-pandemic levels. And up until March, the ATO had already issued statutory demands against corporate debtors of about 1,700 this year so far. So I guess it's interesting that the ATO are focused on getting taxpayers to comply, and ultimately they really do prefer that taxpayers comply voluntarily. They've tried to improve engagement by trying different things. There was a recent article that people may have read where the ATO have also experimented with a change in the ATO language. So with their letters of demand for debts, they had 2 different mail outs go out and notice that, you know, one particular method resulted in a 40% improvement in repayment behaviour. So just by purely selecting a different language, the ATO were able to improve their debt collection from taxpayers. So they really are interested in helping clients comply without too much interaction from the ATO. But I guess for our clients, if you are falling behind, please get in touch with us. We can work with you and help you engage with the ATO to get all your debt or compliance under control.
And Donna, it is, and now you've got personal liability as a director for PAYG withholding, superannuation and GST. Even if you haven't lodged it, it doesn't matter. I've seen them making estimates, because they can, if you lodge one, they have the systems that can work around the back to be able to estimate out going forward.
Yeah,
so
absolutely.
And it is one thing it's not for the complying companies, but it's also for the people that they deal with, and that you'll see some signs of it at different stages, and you can also look out for the ATO issuing notices which are public, so that you can consider whether there's any issues for you going forward from there.
Yeah, a couple of things to note. The ATO really is a data-led organisation. With single touch payroll, they do have a lot of that information, which helps them to make those estimates. The other thing, which I think a lot of businesses may not be cognizant of, is that the ATO can also publish tax debt if they're greater than $100,000. So that'll go against your credit history. So it is a different landscape than previously.
That's aside from garnishee notices and all those other fun things that they can issue as well on top.
Yeah.
So they will. You need to engage, otherwise they will come.
Yeah, absolutely. The more you engage, the better the outcome.
Yep. Okay. So let's talk about some fun stuff. The feedback on the budget's been a little bit all over the place. There's everybody having a whinge, as they always do. That's still not enough for the housing crisis, and it's not enough for small business. The government's obviously got a lot of issues around how they deal with the inflation happening at the moment and how they try and manage that. The government saying that the budget is non-inflationary, but it's very difficult to see how that actually works, given they're spending more money than they're taking out of the economy. And here we have a few of the sort of commentary around it. So the bigger issue is that could drive further interest rates at the back end of the year, and then that starts to put more pressure on the economy, which I think is severely under pressure. I don't know that we are going to slip to recession given the strength of the jobs market. That's probably the big thing that's holding us together. But we are definitely going into a sort of decline in growth, and whether that gets to 2 quarters of below zero or whether it actually just steadies out and stays there for an extended period, that'll be where we see. And that's some of the issues that I think needs to be dealt with. I mean, how do we deal with this housing crisis? Some of the housing crisis is actually not driven by anything the government control. There's a lot of supply issues there. There's also issues around quality. And then there's obviously issues around funding that needs to go in. With all of this uncertainty, it's very difficult for a funder to actually be sure about putting money into a project which might not complete for the next 2 to 3 years, particularly in units in Sydney. Other states are probably more robust, or they're probably recovering. But there is a certain irony that Sydney is probably the greatest challenge in terms of supply needing to change pricing. But there is difficulty and uncertainty with the funding structure that goes with it. So something needs to happen there with all of those issues to be able to somebody to make a decisive approach, or we have a summit or something along those lines to get everybody on an even keel and provide some more certainty. In terms of small business, the difficulty with giving a boost to small business is it's clearly inflationary relatively straight away. So, and there is a lot of pressure on small businesses. It's very hard to get employees. There's obviously a challenge with that, which means you've got to pay them more, and that's an inflationary factor as well on top of all of those issues. And a lot of small businesses are chasing or facing issues they haven't faced for a long time, where there is declining demand, and it's about being able to refine your business to be able to get it to the right standing to be able to continue. As is always the way, the good small businesses run by good management will make most out of this and will create some opportunities, and that will be for acquisitions, and we're already seeing some of that sort of acquisition and acquisitive sort of thing happening, and some of the other ones that have been able to survive through COVID because of the support and whatever else, but haven't really been able to change or adjust their business to make it work going forward. They'll continue to fall by the wayside, as will some of those other businesses that have reached the end of their funding position. And because of interest rate changes, if you look at the tech investments and other emerging startups, the value of those businesses because of the change in interest rates is now closer to zero than it was 12 months ago. So would you be putting more funding in for something that may turn into a great capital investment, but it's unlikely to produce profits to be able to pay for itself in the next 12 months to 13 months to 25 months? That's where a lot of people are deciding, why would I put that money into there rather than putting it into a bond where I can get 5%? So a lot of those things will continue to have funding pressures. So with all of those things, questions for the panel. If we deal with housing crisis and small business support, would that drive inflation and create pressure on interest rates?
I was reading that the Labor Party this morning again talking about bringing in negative, removing negative gearing, and I just wonder, like you can see when they bring in policies like no stamp duty on houses up to 1.5 million, you get these really unusual market anomalies where you have houses that were worth 1.4 all of a sudden are worth 1.5, and houses that were worth 1.6 are all of a sudden worth 1.5. So, I mean, some sort of sweeping policy like that, maybe something that they look at again and doesn't cause that sort of pressure. But I don't know, it was pretty unpopular. Would you see something like that? So how would that affect the economy, do you think?
I think that'd be an real election issue if you took away negative gearing or you refined it and whatever else. And then again, it creates more uncertainty around, if you want rental stock, well, negative gearing probably helps you provide rental stock to some level.
Yeah, absolutely.
And yeah, next one. Looking forward though, what does that mean for the stage 3 tax cuts?
Yeah, well, they're still there at the moment, and they've been legislated for a couple of years. So that's up to 200,000, a tax rate of 30% for individuals. You've got to add Medicare levy on top of that, so it's broadly 32%. But that's substantially different to at the moment. It's 45% for people at 180 grand plus 2% Medicare levy, or 37% for the bulk in the middle there. So we've seen in the past levies come in, like the budget repair levy, and that sits outside the tax rate. So I don't know if we see something like that, but we've still got another budget, I would imagine, before they can properly come in. But yeah.
Well, if you look at these three things on screen, you shuffle them, right? So the inflation is the primary one at the moment. Interest rates are being used to smash it down to be able to get it back under control. So if that gets under control in the next 6 months by putting rates up, that obviously has an impact on the economy. So the back end of the year, we're in a depressed economy, and there's issues around investment, there's issues around employment and the gradual turnover. So surely the government then will actually need to stimulate the economy, and the stage 3 tax cuts are probably a reasonable way to do that.
I think at the moment everyone's taking a bit of a hit, and then we look good after the back of the next budget. It brings us back up.
Or do they make the leap, the massive leap, and they change GST?
Well, you could try that approach, Todd, but your challenge with moving something like GST is that because it involves so many state-based stakeholders, it's politically probably quite a hard thing to do.
Unless they're all Labor governments.
Yeah, but then the challenge is that usually you can attribute every negative outcome to the other political party. As soon as you're all the same party, then you've got no one left to blame when it doesn't work.
Aren't these the battles that we're going to have? So inflation needs to get under control. So unfortunately, we're going to have to bear the further interest rates until that actually happens. But there does seem to be a bit of a two-step economy going on at the moment, where there is a lot of depression sort of factors in the economy at the mid-market and the SME factor, but some of the other areas are still making good money and are expanding. So, Joel, is there anything else for corporates and whatever else in the budget that might be relevant?
Yeah, look, I was a little bit surprised to not see some kind of pushback officially on the implementation of the new thin cap arrangements, which are at this stage going to be applicable in 45 days, which is, I'd say 95% of taxpayers aren't impacted by thin cap, but the 5% for whom it's a real live issue, there's a really big change there that needs to happen, and not having certainty about what direction that's going in it's quite a big deal for a lot of those affected taxpayers. I also agree with not necessarily just on the international aspect. I'd be expecting to see both the stage 3 tax cuts come through so that the political aspect is dealt with it, because that was one of the key platforms that Labor was elected on. But to see some kind of a rebalancing of the National Disability Scheme levy, so that the challenge with those stage 3 tax cuts is they deliver most significantly for individuals over $180,000, and so I would expect we will have some kind of additional levy that comes in there.
Because the NDIS is just out of budget sort of level. It needs to be realigned.
Well, yeah, I think the government's recognising that the current growth of NDIS costs is exceeding 10%, and they're trying to rein it back into, I think, 6 or 8%. And so you can see there that that's an aspect which is expanding in costs, and the government's got an interesting political situation where they've committed to these stage 3 tax cuts, but they both run contrary to the tightening approach that the Reserve Bank is taking with monetary policy, and they are politically quite difficult to a Labor Party base.
So you got 3 conflicting things, and you've also got a timeline where hopefully the position of the economy at that point is where it actually makes it easy to justify. So we need to be more expansionary at that point, and that's why that would help. And obviously, what have we got? We've got almost 12 months, over 12, 13 months to be able to see that come through. So the time could help them actually get there.
I think so. Look, another thing I would also chuck in at this point is the government's been relatively adept in managing the changes so far for super balances over $3 million. They've pushed the application date back beyond the next election, and they've identified a small cohort who are affected currently. Now, of course, that'll increase over time because that $3 million amount will not be indexed. So I also think we might see in time, in relation to housing, that sort of, was only affecting 80,000 people. We might see a similar approach taken to the level of tax concession available for the main residence exemption. That is, you start off removing some of it, but only for the very small proportion of taxpayers, and then gradually increase the scope of that.
So you're talking about a tax for very, very high asset owners / income earners.
Yeah, I think that's what I would expect to see in the coming years.
Yeah, well, and that's gradually where they are sort of getting to, where they do the consistency in their viewpoint. And I think, Donna, interested in your view is that they are comfortable as long as everybody's paying 30 cents. That seems to be their sort of threshold point, is they want to see at least a balance of 30 cents in the dollar. Otherwise, they get uncomfortable with tax structuring and things like that.
Yeah, I guess that's a fair comment. I think more than anything as well, though, I mean, the rate that people pay tax at really is dependent on the overall economy. I mean, they get the most out of personal income tax, but if corporates are contributing more, etc., then that rate may change. I think what they're predominantly interested in is that tax gap. So the majority of taxpayers are complying first time round without any ATO intervention, because ultimately that's the best outcome for all of Australia. It means less compliance costs, it means more revenue, and easier to manage systems. So yeah, I mean 30% is not a bad benchmark, but comparatively, I think comparatively to the rest of the world, it's probably actually quite low, 30%. I mean, when you look at other countries, personal income taxes in the US are over 50% by the time you add the state taxes in and things like that. So, we could start advertising Australia as a tax haven.
We're not the Caymans. Pete?
I was just, so I actually was interested, throw the mic back to you, Donna, but I just wonder, when you've got, say, the government saying we're giving the tax office this amount of money, we expect this much increase in revenue, is there some sort of strategic change on their end? Like, are they more open to settlements just to get some sense in the dollar, do you think? Or in that terms of how they measure that, is that more without the tax office intervention?
Look, the ATO is I would say, commercial body like any other business. So, you know, if you were to come to them with a sensible proposition, I don't think that they would not consider it. But in terms of them receiving funding and the strategy that they deploy, yes, they do have a strategic plan whenever the funding comes through, and usually it's well before they even receive the funding, because often government will make these bids for these particular risk areas so that, you know, the government knows where the focus areas are. And then they'll have structural changes within the ATO, so create new business lines where they're focusing on that particular risk. But I think the way the ATO has been operating and is continuing to operate is in the data analytics, and you know, they've got to be smarter with the money that the government invests in them, and you know, they have a plethora of data points, and also, you know, every single client of Australia is a client of the ATO, so they've got population analysis that they can do to focus their efforts on, you know, the most return that they can get for that money. And I think that's evidenced by the funding that the GST program's got and the expected return that they're expecting in that area. So they've identified that the risk level there is, you know, out of proportion perhaps to other risk levels, and you know, it's become a key focus for them, and which they're going to tackle.
And Donna, there is having dealt with them on a number of issues over a number of years now, there is this unerring fairness sort of thing that they have in there. It's like, well, how can we do this deal? It's unfair to everybody else. So it's about trying to make sure that they're justified on that sort of basis as well, to be able to say to all parties that they can say, well, we did this for a good reason. Here's all of the reasons, and it's the best outcome for sort of globally for the ATO and for the Australian public. They don't do it because this bloke's made us an offer, it's easier for us, we'll just do it that way. There is an actual analysis that sits in the background.
Yeah, absolutely. Good point, Todd. You know, the key focus also of the ATO is that integrity of the tax system and making it fair for all. I did have experience with some settlements when I was working at the ATO, and there are all sorts of panels that are involved in approving that type of decision. And then there's also outside scrutiny. So you'll have a retired judge who will come across and look at the decision and make sure that it was a fair and equitable outcome for the Australian public, and that what the ATO achieved from that particular engagement was sound. So it's not a easy engagement by any means, and you're absolutely right that the ATO are very conscious of, you know, being fair and equitable to all taxpayers.